Welcome to the TrestleBridge Capital Market Observations Call for the week of January the 9th, 2023. I'm your host, Eric Jefferson, and to kick things off here, I have a few quick words from our legal team. I also want a housekeeping note. The quarterly commentary currently making its way through compliance. That will be available and distributed later on this week. To kick things off, as we typically do, I'm going to start by recapping performance last week. The first week of trading in the new year saw both stocks and bonds appreciate up a few percentage points. Interestingly enough, that was on the back of some mixed data. I had a big update on Friday where we got conflicting information. What markets focused on was the weaker economic data. We got ISM services and manufacturing. That data confirms both of those are in contraction, suggesting that global growth is in fact slowing. That is a classic case of bad news is good news, because the silver lining with slower growth is typically deflation or lower prices. Based on those expectations of inflation continuing to decline, we now saw the market begin to price in fewer interest rate hikes. As we've discussed, it's higher interest rates. That's the mechanism that the Federal Reserve and other central banks will use to purposefully slow an economy in order to get runaway prices or inflation under control. That is the first order or mandate of the Fed's goals, responsibilities. The second mandate is to maintain full employment. And last week, the conflicting data that we got was reinforcing a very strong, very resilient labor market. We saw payroll data beat expectations. We saw unemployment fall from 3.7 down to 3.5%. And so if you were taking Economics 101, you were given a scenario where inflation is still 3.5 to 4 times above its long-term average. Granted, it has begun trending lower, but still way, way above acceptable levels. And then on the other hand, you had labor markets that were actually improving versus worsening. The conclusion you would likely be drawn to is that additional interest rates would likely come because you have the strength in the labor market. You're able to rise interest rates again to combat that historic inflation. Yet markets are actually doing the opposite. They are expecting that inflation will come down faster than growth is slowing. Which gets us to the importance of, again, what are the rate of changes in both of these going forward? Ultimately, based on my seat, I think the market was maybe a little overdone with some of the enthusiasm, again, in just this first week of trading. As we shift globally, China is officially reopened. There are no longer those quarantine mandates when you arrive. So if you've been thinking of making a trip over to the mainland, you are free to go ahead and do so. Not surprisingly, that has sparked a rally in stocks globally based on enthusiasm for the second largest economy coming back online, which in turn has also driven up commodities prices. Think energy, which interestingly enough also puts further upward or additional pressure on inflation. So somewhat of conflicting report there. Ultimately, though, market interpreted the news in aggregate last week as being overwhelmingly positive and thus traded a good bit higher. As we look to the week ahead, on Thursday, get CPI, Consumer Price Index, that is inflation data again. Going to be very, very important thinking about not only what those headline levels are, expectations are for inflation to continue to decrease. I think, though, the focus is going to be what is that rate of decrease or how quickly is inflation falling? Also, when we think about the different pockets or components of inflation, some tend to be more stickier than others. I think the question is going to be for those stickier pieces, has there been any progress there? Again, you think about a headline inflation number, it's easy for the transitory pieces of disinflation to have that immediate effect. But if the Fed's goal to get inflation back down to 2%, you're going to need some of those stickier components to make progress, which we haven't necessarily seen thus far. And then finally, on the geopolitical front, we saw some progress in DC. Turns out the 15th time is a charm for the House majority. Kevin McCarthy finally received the votes that he needed to become Speaker. This is a theme that we'll talk about in the commentary released later on. Historically speaking, having opposing political parties occupying different branches of the government, typically a good thing for capital markets, thought process being that where different parties are less willing to work together, that decreases the probability of any meaningful regulatory or tax change. Therefore, companies can go out and do what they do. The opposite, though, is true. When things are bad and you need government to come together, that's where you can certainly come across some very challenging times. We saw that in 2011 with the debt ceiling. We saw that again in 2013 with the federal government shutdown. And experts are forecasting at some point, likely this summer, early fall, the US government will have to once again increase its debt ceiling, or the amount that it is able to borrow in order to fund its operations. Again, we saw with just the division within the House majority electing a speaker. What does that suggest or speak to the probability of our entire government congressional branch coming together in order to raise that debt ceiling, which again, all likelihood will have to do. Something we'll continue to monitor very closely, as arguably that is not on the radar of markets and traders thus far. But that's all for this week. As always, happy to discuss anything in more detail. If you don't connect, have a great rest of the week. Take care.